You have to solve the problem of separating your income from your time if you want to retire early. Early retirement sounds like the dream. Freedom, flexibility, time, but here's the catch. How do you fund your life without actually clocking in? So I'm going to go through the argument of utilizing two powerful strategies, dividends versus rental income, as a method to potentially solve this problem. Okay, so let's start with how a simple dividend investing strategy can serve as a foundation to provide predictable passive income, all while growing your investment in retirement, giving you the peace of mind that you don't need to drain your assets to pay all your bills and you won't run out of money. It is significantly easier to start building up a dividend portfolio than it is to acquire a rental property, as you can start with a relatively small amount of capital. In addition, dividends can offer the potential for a steadier and more predictable income stream than rent from a property, as rental income can fluctuate depending on the local market or the specific property. Dividends are typically paid out regularly, making it easier to plan and budget for your future. And yes, I understand that there's the same argument for REIT investing, which is essentially buying ETFs in the stock market that are invested in properties. And you can own a small percentage of the property as with stocks. However, the value of ownership and the rental income from the property is lost. A simple dividend investing strategy allows for time off on the weekends and public holidays as the stock markets are closed. However, rental property investors have to be on call 24/7. Just like us the other day, we had to phone our landlord on a Friday evening because all of a sudden the tiles started lifting and cracking. Although these calls don't happen often, they could ruin your weekend plans and sometimes be unexpectedly costly in order to repair. Dividend investing also offers more flexibility when it comes to location. With rental properties, you're tied to a specific geographic area if you want to move or invest in another country. This can make buying or selling rental properties way more difficult. With dividend stocks, you can invest in companies located anywhere in the world. This diversification helps to reduce risk and also potentially boost returns. If you've been enjoying this video so far, please like and subscribe to the channel. As a landlord, you have to accept the risk that there may be times between tenants when you aren't able to receive a rental income. And if a tenant who previously produced reliable rental income finds himself unable to pay for rent or other expenses, then this can put real estate investors in a sticky situation, as landlords are typically powerless to evict abusive tenants. This can become costly, both in terms of lost rental income and potentially facing unfortunate legal situations. Whereas with dividend investing, this could be a much safer option, as you won't face these kind of problems. Although the businesses have the ability to halt or reduce their dividends, you can research the company's financials to see how safe the dividend is and what level of risk you will be willing to accept. Another consideration is the exit strategy. Both dividends and real estate have their pros and cons, but dividend stocks tend to offer a more fluid exit strategy. This is because shares can easily be bought and sold, and investors can quickly rid themselves of a stock if they need to. In contrast, the process of selling a real estate can take months, and it's often necessary to enlist the help of a realtor. There are many negotiations, waiting times, and fees that must go off before the money is even received. Therefore, dividend stocks present a much more liquid path to exit for investors. When it comes to looking at the tax effect, there's slightly more advantages to dividends, unless the rental property is registered separately in a company's name instead of your own, as that would be the best case scenario. There are usually local and foreign dividend exemptions, but I am speaking under correction, as this may not be the case in every country, where a portion of the dividends received are exempt from income tax based off of certain conditions and to a certain threshold. However, with rental income, the total will be included with all your other income you earn from your multiple income streams and taxed based on a marginal income tax rate, which works on a sliding scale. So moving on to dividend investing versus the standard 4% rule for an early retirement strategy. Many investors are choosing dividend investing as a strategy just because it's become popular on social media. But regardless, if you do want to retire early, you are going to have to work really hard or become really creative in ways to make money in the first place. But there are many different ways to do that. It is important to note the difference if you are going the route of being a solely focused dividend investor rather than a standard index or individual stock growth investor in terms of a total return. as you would be better off focusing on the total return, that being the share price and the dividend, and not just focusing on the dividend. It's important that you educate yourself and understand that, because you don't want to psych yourself out when it gets to the end of the year and you're sad because you underperformed the market. Remember, the fundamentals that you're trying to achieve are different. But on the plus side, you are going to see a lot less volatility and fluctuation as well, because dividend stocks are generally seen as a defensive stock in a bear market. When the market is going down in more volatile times, investors generally flock to the safer dividend stocks, as they are often more stable companies providing returns in this way. With dividend investing, there's no risk of timing when it comes to selling out some of your shares. But with the 4% rule, you are choosing a time each year to sell off a chunk of your portfolio. And if there's a bear market during this time, then it is much riskier to your goal of living off of this portfolio or your retirement nest egg. The thing with the 4% rule is that it is much more straightforward and easier to plan, but more on that in this video here. The standard 4% withdrawal rule can also feel a little riskier today, with higher stock market valuations, with lower future returns and higher inflation, which might force you to withdraw more money than you had planned to down the road. But dividend portfolios are usually set up much more conservatively, and minimal trading is required to continue this method. It's usually a buy and hold situation with an annual look at your portfolio just to adjust for any of your needs, or to buy more dividend producing stock with any extra money you may have made. Other things to take note of is, although dividends can get cut, dividends generally increase over years as companies grow a stable base and find ways to stay innovative and increase their profits, unlike bonds where you lock in at a certain rate and only fixed payments are made. Also, avoid paying fees to an advisor and picking dividend stocks yourself to align more with your goals, as these fees will take large chunks of your net return away from you later down the line. I would really encourage any new investor, as painful as it may be and as boring as it might be at first, I would really encourage you to just start with ETFs. Just build a good diversified foundation. Learn from other people's mistakes and just walk before you run, and start with dividend ETFs before picking individual stocks. Be patient, just get some skin in the game, and develop discipline and consistency with just contributing towards your portfolio of ETFs. At the end of the day, I think dividend growth investing provides some unique benefits compared to other passive income strategies. But just because a company pays a dividend doesn't mean it's a superior investment or resistant to price drops in the broader stock market. In theory, whether your retirement cash flow comes from your dividend income, bonds, rental income, or partial sale of your portfolio holdings shouldn't really matter. Pick an approach that works for you and stay consistent over the years, learning and contributing more money. So thank you for watching, subscribe to the channel, and as always, stay money minded.